Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and another spectacular week ahead of us. And we certainly had a fantastic week last week. We were bullish gold, how wonderful, bullish oil, how wonderful, bearish stocks, and it finally started to come into fruition again. I did say several times we were going to have that short-term consolidation phase. That looks to be over actually, and the price action for equities looks simply diabolical.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
So I think there's going to be some significant downside for equities over coming weeks, and it's something to remain incredibly mindful of because it could be a significant impact on people's portfolios. On the positive side is, of course, you have the instruments to take advantage of such a move, especially, and remember, the biggest moves happen, the biggest money is made when the market is wrong. And the market has been wrong for 2 years about interest rates. So they're still wrong. And I keep saying they're still wrong every week, every month for the last 2 years. And the market has been wrong, and I've got it right. Interest rates longer are going to stay high. I did a TV show on Friday where I greatly emphasized that point. This means the correct pricing of equities relative to interest rates is still not very much in place yet. The market is way too high, and people talk about P/E ratios being relatively normal, but we should be at the bottom of the historical range of price to earnings, because the economic outlook for the world economy and the US economy is extremely troubled. There's not going to be any interest rate relief, and there's not going to be any policy relief. Meanwhile, we have geopolitical tensions constantly on the rise, fresh sort of areas of crisis and stress emerging almost weekly, unfortunately, and that means that the world's going to be caught short of oil supplies again, and Europe particularly of natural gas supplies through winter. So energy prices still going higher. That's going to immediately feed into the inflation number. And that last week's inflation number in the US was as I expected, but it caught some people off by surprise. But the thing is, I think inflation can be above 4% by the end of the year. That's because energy prices are going to stay strong, and pricing pressures in the US economy are still very strong. So if I'm not saying the Federal Reserve should raise rates. I've said a year ago they should stop, but I did forecast, probably more accurately than any of the major investment banks in the world, that we were going to have the Fed running late to play catch up and overcook the books. And that's exactly what we're seeing. And the Fed, if it remains, maintains this blinkered view that it has to attack inflation without understanding that it's not the inflation of last century, and you shouldn't be using last century responses, then they're going to continue to make the mistake of raising rates further. So don't think this is a game that is over. We could see rate hikes in the first quarter of next year. So still a lot of interest rate pressure to come to bear on equities. The US dollar, well, it's like gold and oil are becoming the new safe haven currencies, to be honest. I think that's the big call, that the new safe haven currencies are gold and oil, because the world's going to remain desperate for energy. And as all of this uncertainty begins to hit about the fiscal disaster that's occurring on a weekly basis in the US now. I think their debt at the moment is going up at $1 trillion a month. And you've got to remember, we're talking about, debt spending that far exceeds that of other major economies or even of China. So this is a real fiscal crisis that is deteriorating rapidly all the time. And we've already seen the political ramifications of that with removal of the speaker, and only a kick the can down the road for a short while approach to keeping the government of the United States running. This is a major historical crisis period, but like the frog who's in the saucepan and it's gradually heated, lots of us frogs aren't realizing this is an extreme situation. So interest rates higher for longer, people becoming increasingly concerned about the growing uncertainties that are there in the world and in the US economy. On Friday, we saw US consumer sentiment fall away again. I mean, in the last year, it's been lower than it was in the GFC. And yet you have people saying the US economy is strong. The only reason consumer spending and retail sales look good is because they're not inflation adjusted. People are cutting back on quantity, but prices are going up to keep that sort of data supported. People are hurting in the United States. Consumer confidence number. The small business sentiment index out last week was just absolutely terrible for the United States. So across the United States, most Americans are doing it very tough. Ivory Tower Wall Street is increasingly detached, but that detachment can't last forever, because where does the wealth really come from? It comes from hard-working Americans or Australians, wherever you are, going about producing goods and services every day that have value to other people and other people purchase. But the other people have to have the money via employment and not just already pre-existing wealth to continue to buy those goods and services. And people are slowing down on that spending. So just bear that in mind as we see data unfold this week. But the US economy is really in a dysfunctional state. The fiscal crisis is historically extreme, and I don't see how even higher yields can continue to support the US dollar. So at some point the US dollar cracks. Look at gold and oil. They're strong even with a stable US dollar and a recently strong US dollar. If the US dollar begins to crack, gold and oil just shoot higher. So we're going to see gold up around $2,400 over the next 2 years, and that's a big move. So that's something to bear in mind. And I think oil's probably going to break that 96 resistance this time and head to 107, 108 in coming months. So a lot of pressure to come still on inflation in the US. I'm thinking it'll be above 4% by the end of the year or early next year. And the Fed will not be cutting rates to rescue the economy, and the economy will begin to spiral. So that sounds negative, but it's actually saying it as it is. So it's better to be prepared, pre-warned, than it is to be surprised by it because you wanted to believe something else. So, and there's plenty of market opportunity that comes to bear from such circumstances. It's an historically rare, special moment. Therefore, the opportunity for correct trading and investment decisions, those opportunities are as big as they ever get right now. I hope you have a good week. Thank you very much. Clifford Bennett.